Hello everyone, my name is Jang from Handong Global University. I'm going to present our paper, Effects of a Macroeconomic Business Cycle on Earnings Management, evidence from Korean companies. So contents is introduction, literature review, research methodology, results of empirical study, and lastly, conclusion. So let's start with the introduction. So we examine the relationship between macroeconomic business cycles and earnings management, specifically whether firms make more earnings management during boom period or contraction period of macroeconomic business cycles. By definition of earnings management is management's activity to change their earnings to get what they want by changing accruals or real activities. Accrual means non-cash expense, and real activity is by changing cash flows. So studies on impacts of macroeconomic factors on individual companies' financial decisions are increasing trend. For example, Manglin and Zhao, they study the business cycle's effect on companies' investment decisions. And et al., they examined a relationship between the macroeconomic status and capital raising, and the study revealed that the macroeconomic status influences their capital raising structure and their capital raising capacity. Also, various studies on earnings management have been performed. They analyzed earnings management from various perspectives. They check the earnings management activities by listed company and versus a non-listed company, and small or medium enterprise versus large companies. So impact of capital structures and the financial statement characteristics, and different industry using accrual-based earnings management and the real activities-based earnings management. In earnings management, as I mentioned, they are the management activity to changing their earnings to get what they want. And this accrual-based earnings management is they are changing non-cash items like depreciation and the bad debt expense. That's what we call accrual-based earnings management. And another thing is real activities based earnings management. This is earnings management including cash flow impact. For example, their sales increase by loosening credit policy, and also they are spending less SG&A to increase net income, and also they produce more product and allocate more cost and inventory, and then reducing cost of goods sold, and then increasing um, uh, earnings. That's what we call REM. Okay. And there are several studies on the relations between the macroeconomic business cycles and the earnings management using US and Chinese company data. And Conrad et al. And Cohen and Zaroin and Wang et al., they made several studies on that. And their result is one is counter-cycle earnings management, another is pro-cycle earnings management. So counter-cycle earnings management means during the contraction period, they make a more earnings management to show a better result, and they are less earnings management during the boom period. That's what we call counter-cycle earnings management. Pro-cycle earnings management is they are doing more earnings management during the boom period because to avoid negative response from analysts. And then they are doing less earnings management during the contraction period because everybody knows their performance is not good. So, however, there is no consensus on whether earnings management is counter-cycle or pro-cycle. So we examined the relations using a data set of Korean companies from 2005 to 2017, and we conducted a study using a fixed effect panel regression model, while previous studies used a pooled OS model. And our method is more sophisticated and can find out better on the earnings management behavior. And then we expanded also study from just in the past focused on the AEM, accrual-based earnings management, but we expanded to accrual-based earnings management and real activities based earnings management. And also we used more extensive data set from 13 years, but the previous study is 7 to 8 years. Okay, and then next step is literature review. As I mentioned, various studies on the roles of macroeconomic environments on individual companies' financial and business behaviors are increasing. And the business cycle and investor sentiment by McLean and Zhao, and business cycle and capital raising capability et al., and business cycle and capital structure choice by Krozaki, and business cycle and expected bond and stock returns Pharma and French. And then studies on the relationship between earnings management and business cycles, and the earnings management started by Healy and Wallen in 1999 and expanded to Skipper and Kothari and Cohen and many other studies. And then Conrad et al. And Cohen and Zarowin and Wang's research on the relations between earnings management and business cycle showed that pro-cycle relationship using US and Chinese data set respectively, and Park and Kong study indicate a negative relationship, which means counter-cycle relationship, which, as I mentioned. Okay, and then next is our research methodology. So our research methodology, we start on the variables, dependent variables, and independent variables. Dependent variables, as I mentioned, the earnings management. There's two kinds of earnings management: accrual-based earnings management and real activities-based earnings management. As I mentioned, accrual-based earnings management is management change their earnings by adjusting the non-cash items like depreciation, bad debt expense, etc., etc. And Kotari developed a model measuring this AEM below like this. And then he defined DA, discretionary accrual, equals total accrual minus normal accrual. So total accrual is basically net income minus CFO, cash flow from operations. So basic thinking process is total accrual, and so normally this accrual is changing in proportion to sales increase or sales decrease. So total accruals exceeding this normal accrual, which is in proportion to sales, is we define as discretionary accrual, and this discretionary accrual we define as accrual-based earnings management. Okay, so total accrual is we using this data, and then discretionary accrual is total accrual minus normal accrual, and normal accrual is, as I mentioned, accrual in proportion to sales increase. Okay, that's what we call accrual-based earnings management. And real activities-based earnings management is it including cash flows. As I mentioned, they increase sales by loosening their credit policy, and also they reducing SG&A cost to increase sales. Okay, that's what we call real activity-based earnings management. There's the three components: was abnormal cash flow and abnormal production cost, abnormal selling and general administrative expense. So basically, total cash flow and the cash flow cash flow exceeding normal cash flow, which is in proportion to sales. This is normal cash flow in proportion to sales increase, and exceeding this normal cash flow we call abnormal cash flow. Abnormal production cost, same concept: total production cost minus normal production cost. As sales increase and they produce more, exceeding that proportion to sales we call abnormal production cost. And abnormal SG&A cost is SG&A cost exceeding, okay, exceeding or lower than a normal sales increase. If the sales increase, they spend more SG&A, and then the change in SG&A is bigger than this change in sales increase that we call abnormal SG&A. Okay, and then we real earnings management measurement is 1/3 of ACFO, APC, and ASGA. Okay, this is a real activity earnings management. And then we controlled many perspective. We controlled company size and leverage, liability equity ratio, and the return on equity, and total asset growth, and total accrual, and net loss. So independent variables is basically relating to macroeconomic business cycles. So composite index is composite economic index, including industrial production and construction, retail sales, employment size, and domestic shipment index, and imports. That's we composited all these indexes in this CI. And then we looking at the real GDP growth rate. In period T, real GDP growth rate is impact how they impact on its management, and we call it detrended real GDP growth rate, because under certain trend maybe that trend impact on its management, so we exclude that trended impact. That's we call detrended real GDP growth rate. And then business survey index. So this is a key independent variables. So we are looking at how these independent variables impact on AEM and then REM. So research model, so base model is like this. So which is this EM means earnings management, and then YT is a macroeconomic variable representation, the condition of real business cycle in period T, and the ZIT is firm level control variables, and then UI is fixed effect terms of each term, and then lastly error terms. So extended model is we use total 5 AEM model and then 5 REM model. Okay. So basically, the first model is AEM, accrual based earnings managed by the base model, cash flow model, and then model 2 is composite index impact to AEM. Model 3 is real GDP growth rate impact on AEM, and then model 4 is detrended real GDP growth rate impact on AEM, and then BSI impact on AEM, and then remaining 5 REM is same. Base model, and then the composite index impact on REM, and then real GDP growth rate impact on REM, and detrended real GDP growth rate on REM, and then BSL on REMs. Okay, next is result of empirical study. So we're looking at total firms, and then we split the manufacturing company and non-manufacturing companies. So total firms. The first is how these independent variables impact on AEM on total firms. If you look at it, is composite economy index has a positive relationship with the AEM at 1% level, and also real GDP growth rate also has a positive relationship with AEM at 1% level, and detrended the real GDP growth rate also has a positive relationship with AEM and 1% level, and then lastly, business cycle business survey index has a positive relationship with AEM at 1% level. And then total firms with REM is model 6 to model 10 is REM, real activity-based earnings management. So composite economic index has a positive relationship with REM at 1% level, and real GDP growth rate also a positive relationship with REM at 1% level. And then, And then the trended real GDP growth rate, also positive relationship with REM 1% level, and business index. Business survey index has a positive relationship with the REM at 1% level. So now let's look at manufacturing firms and non-manufacturing firms. And so manufacturing firms relationship with the AEM and REM, okay? And then these independent variables, composite economy index with the AEM is a 5% level positive relationship, and then real GDP growth rate also 1% level positive relationship, and the trend, the real GDP also 1% level positive relationship, and business survey index also positive relationship with AEM 1% level. This is for manufacturing firms only. And then manufacturing firms on REM relationship is also very similar with the previous one. And composite economy index has a positive relationship with REM at 1% level, and then real GDP growth rate has a positive relationship with REM at 1% level, and real GDP, the trended real GDP has a positive relationship with the REM at 1% level, and then business survey index also has a positive relationship with REM at 1% level. And okay, now let's look at the non-manufacturing only. Non-manufacturing relationship with the non-manufacturing companies, macroeconomic business cycle, and AEM, and they all have 1% level positive relationship. If you look at it, composite economic index, real GDP growth rate, and detrended real GDP growth rate, and business service index, survey index, they all have 1% positive relationship with the AEM. And then only one difference is here, non-manufacturing firms, in case of mostly not no significant relationship here. If you look at composite economic index and real GDP growth, and then detrended real GDP growth rate and business survey index, they all have very limited relationship, no significant relationship with REM. Okay, so we look at the empirical result and our model. Let's make some conclusion here. So we examine the relationship between macroeconomic business cycle and the earnings management using a data set of Korean companies. And we found the business cycle has positive relations with earnings management, which means companies are performing earnings management more often during the economic boom stage than during a contraction period, which means this is a pro-cycle, not a counter-cycle. And the explanation for the result is that the companies are performing earnings management more often in the booming stage to avoid investors' negative response for poor performance during good economic periods. So implication is this study result could provide insight to auditors, investors, and accounting policy setters in terms of company behaviors regarding earnings management. So, for example, auditors could pay attention to the possibility of earnings management during the good times in performing their external audits. Also, investors, they can pay more attention to the disclosed numbers of the company during boom period, not just the contraction period. So limitation is we adopted a simple linear regression model to enjoy the advantage of panel regression and then to avoid the complexity of the issue. And in the future, it is necessary to design a complex structural equation model. Okay, so this is the end of our presentation, and thank you.